Hi, good afternoon, everyone. Thank you all so much for joining us today. This is our quarterly webinar series titled CIO's Corner. It's a quarterly update with our Chief Investment Officer, Chris Gauthier. And for those of you who are joining us for the first time, my name is Amanda Sylvia. I'm the Client Service Associate for Stonehearth, and I've been with the firm for about 6 years now. My primary role including client service, marketing, and compliance. I do want to start us off with just a few housekeeping items. So on your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I'll be monitoring all of them, and I'll ask Chris to answer as many as time allows at the end of the webinar. If we do happen to run low on time and are unable to get to your personal question, Chris or I will reach out to you directly after the webinar to make sure we do get your question answered. I do want to go ahead and introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both the institutional and individual investors. He's responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, and good afternoon, everyone, and thank you all for joining us today. Well, it certainly feels good to put 2020 in the rearview mirror, and I'm sure all of us are looking forward to a much brighter 2021. So with that, let's jump right in. Let's look at what we're going to look at today. As always, we're going to look at asset class performance, and really when I look back on 2020 in the equity markets, it really was 4 separate distinct time period markets rolled into one. We started off the year with the pre-COVID mega cap growth rally, think the Googles, the Facebooks of the world. And then really around the end of February, COVID reared its ugly head, we had lockdowns, and we saw some massive underperformance by value stocks. Then really at the end of March to September, we saw that mega cap growth trade come back in style, along with some, work in shop at home stocks. And then, as we'll show you later on in the presentation, really saw a sea change at the end of the year, really beginning in September all the way to the end, where we saw this reflation rally, which was led by small cap stocks. And that really is a play on the economy returning more to a normal state run rate as we move forward in 2021. We're also going to take a look at the investment environment. We always look at the investment environment through our multiple lens approach, and we use technicals, valuations, and economic data to understand the current investment environment. We will discuss how the positioning portfolios for 2021 using our weighted the evidence approach. And as Amanda mentioned, we'll leave some time at the end for some questions. So with that, before we jump into the performance, I always like to go through our investment philosophy here at Stonehearth Capital, because it provides a nice framework for our conversations and gives you a better understanding of some of the conclusions we come to when we look at this data. We here at Stonehearth do believe in mean reversion. Trees don't grow to the sky. Price matters, so valuation, what you pay for something really is the main driver of returns. Exposure to core factors like quality, value, momentum offer long-term excess returns above the market rate. Diversification is still the only free lunch, and we'll see as we look at Q4 that really came into play for performance. And as always, risk is not stationary, but really does fluctuate throughout the market cycle. So turning to the fourth quarter, we're looking at our standard asset class chart here. And as a reminder, if you're joining us for the first time, anything in blue would be the US equity market. You can see that light blue color. Anything in green will be international equity. Anything in purple is in the fixed income land, corporates, preferreds, treasuries. And anything else will be in yellow, which we call the alternative asset classes. So as we mentioned, we look at the fourth quarter. I mean, the reflation trade was alive and well as animal spirits were running very high. As we mentioned, performance was led by small caps, almost up 32% in the quarter, just amazing. One of the best quarters we've ever seen from small caps, and really was on expectations of more stimulus with the new administration in Washington, and really that hope that we may have turned the corner on COVID. And we did really start to see some reversals in performance in the equity markets, as lately we have not been seeing international outperform US, but we saw that in the fourth quarter right here, which is represented in green. We saw international small caps, international diversified, think about Europe, Japan, and emerging markets, think more about South America, Vietnam, and things like that, all perform and beat large cap US equities, which still performed a respectable 12% in the quarter right here. In fixed income land, turning to the purple, it really was a credit over duration. As you can see, convertibles, which has equity-like characteristics, so it's not a true fixed income. But in the credit markets, what we consider credit is high-yield bonds, floating rate bonds, preferreds. You can see they really did beat treasuries, which is representative of duration during the quarter. But overall, when we look at the fixed income market, we look at the aggregate, and that's this ag right here. Not a lot of return to be had. It was basically flat in the quarter. Bringing up the rear is the dollar as it continues its downward slide, and it was the worst performer in the quarter. Overall, when we look back at the fourth quarter, it really was a good ending for financial markets in 2020, and we do see this momentum continuing into 2021. Focusing on factors, so drilling down really in the US equity market, we look at it through multiple lenses, and the factors we look at are value, stocks that are trading cheap on traditional fundamentals, quality, companies with strong balance sheets, good management, momentum, stocks that have risen in the past because they tend to rise in the future if they've risen in the past, and higher yielding stocks because you have little safety net with that dividend. When we look at it, we see value as far and away, which is this blue line, up almost 19% in the quarter. It was the best performing factor in Q4. And it really is the most exposed factor to that reflation trade and was a sea change. High yielding stocks, which do have a lot of overlap with value, also beat the broad market in the quarter, up almost 14%. Quality was basically the market. You can see it right here, almost the overlap with the S&P, around 12%. Momentum brought up the rear, but still posted a very respectable 9.6% return in the quarter. This represents a reversal of the factor performance we've been seeing in 2019 and for most of 2020. And we do think this is a start of a longer term trend in the markets and may provide some opportunity to pick up some excess return in 2021. Taking a step back and taking a broader view of the 1 year performance, even with that strong Q performance from the small caps and the international, it really was not enough to change the year over year performance, as we saw little movement in the performance rankings. So if you were first place last quarter, which convertibles were, you're first place this quarter. They were the big winner in 2020. Again, they had a little bit of backs up from the Fed because they're bond-like, and they also had that nice tailwind from the equity market because they have that equity kicker in there. But they were the best performing asset class in 2020, with the NASDAQ up almost 50%, not far behind. Precious metals were strong, represented by silver, almost up 50% as well, and gold, a little bit half of that, but still 24%, followed by the S&P 500 at 18. So not quite as high. The overseas markets represented in green here still did manage to deliver very robust returns, as emerging markets were almost up little over 15%, and international small cap 12, and even developed, which lagged a little bit, still up 10%. For the year, unlike what we saw in the fourth quarter, credit beat duration beat credit, as long-term treasuries was the best performer, ex convertibles, but they had that equity-like kicker. So we look like here, long-term treasury was the best performer in 2020, but that performance was really front-end loaded. It's not performing as well lately like we saw in the fourth quarter numbers. This yellow line over here, which is almost off the charts, is oil, down almost 70% year over year, and it still has a long way to go, even with the recent rise we're seeing. And the dollar is still down on a year over year basis, almost 7%. So that's a little summary of what we saw in performance. And now let's take a look at the investment environment and what we're seeing in the current markets. So we'll start with the US equity market. We're using the S&P 500 index here as our proxy, going back to 1996, and really looking from a long-term technical perspective, all looks good, right? As the index is heading in the right direction, upwards and to the right. For those in the US, it's heading to the northeast. So that's good. We did see that large correction of COVID burst onto the scene in February, this big drawdown right here. We saw that in the first half of the year, followed by one of the fastest recoveries from a 30% decline we have ever seen in the markets, and broke out to new all-time highs. So looking from a technical perspective, all in all, it's a really very healthy technical setup in the markets that we're seeing. Turning to valuations, not so much. We get a much different picture, as valuations look extended, to say the least, no matter what metric we use. And what we're using up here is a traditional fundamental metrics, PE. All PE is a price of the index divided by the total earnings of the constituents. So, how much for $1 are you paying in earnings? and we're looking 12 months out. We use the Shiller's KPE, which is a look back on earnings, so it looks back 10 years and takes into account inflation and business cycles, dividend yield, price to book, all traditional fundamental metrics. And you can see on this right-hand side here, when you look at the standard deviation of over undervalued compared to history, they're all off the charts, all greater than almost one standard deviation, other than this earnings yield spread, which is just comparing it to bonds. And as we'll look at the bond market, you see that's really just the Fed keeping rates so low. But on valuation metrics, it's tough to find any metric out there that says this is cheap, just the market's trading cheap. And you can see on this big line here is the forward PE ratio. It's almost at all-time highs, things we haven't seen since 2000. And we all know how that ended. So again, from a valuation perspective, you know, it's trading very richly. But one thing that can help this is earnings growth. And we are seeing good signs on the earnings front. So the number of companies providing positive EPS guidance is higher than we have seen in previous quarters, which is what we're measuring right here. It's just the number of companies that see earnings getting better, that before they announced earnings, they said, you know what, taking into account everything we're seeing a lot, we expect higher earnings coming forward. So again, a very positive sign for the market. Another way to look at how earnings are looking at is EPS growth rates, which is over here, what we expect growth to be, but also revisions. Estimate revisions, you know, is really just analysts. So people who follow the company regularly, follow the company for years, are adjusting their earnings expectations higher. So again, given everything they're seeing in the market, what companies are talking about, they're seeing earnings rising rather than slowing down. So that's always a good thing for the markets. So we see analysts turning more bullish, corporations are still bullish, and this really portends to more continued earnings growth. So how does this translate into actual earnings, like the overall earnings picture? What does again, we're using the S&P 500 as a proxy. And well, we can see even with the hangover from COVID, when we look out at 2021, and we know the market prices things forward, so they price the future. Analysts are expecting companies to earn more in 2021, represented by this 175 number, than they did in 2019 when they only earned 165. So again, a very bright earnings picture, expecting earnings growth as the economy reopens, and overall paints a very positive picture on the health of corporate America, which really should translate into strong equity performance as we move out into 2021. Besides the valuation, one other concern we are monitoring very closely is the increasing concentration of the equity markets, and you can see this in the next chart. So if you look at the top right-hand chart here, you can see the weight of the top 10 stocks compared to its history. So how much of the top 10 stocks weight in the S&P. So you can see it fluctuates at the high of almost 28. You can see that we're almost at record highs. In fact, the recent record high was just recently. So we're just down a little bit, but the top 10 companies make 30% of the weight in the S&P 500. And you can see the disconnect between those stocks, those top 10, and the other remaining 490 or so over here. When we look at the PE ratio again, you can see the gold line, the top 10 stocks, is much more elevated than the remaining 490 so stocks in the index. So again, to us, when we look at this, it represents an opportunity maybe to move down into the smaller cap space because we're seeing better valuation support. So again, the headline numbers, you really have to look into it and really see what's underneath. And again, where you take risk, and we'll talk about this a lot, is just as important as how much risk you take in portfolios. So turning to factors, we saw in the fourth quarter performance numbers that value beat growth and momentum, but over the longer term, it really has trailed by a lot, but we see that gap slowly closing here. So again, believing in mean reversion, we can see that this gap should be closing because you see throughout history it has not been that wide. When we look at the bottom chart, we're looking at the different factors that we use from our friends at Goldman Sachs and painting a valuation picture. So again, all they're using is looking at the value factor, the income factor, size factor, and really understanding compared to its history, what's it trading at? And very simply, if it's up top of the line, that is trading expensive relative to its history. Below the line, right here, it's trading cheaper. So from a valuation perspective, you can see value, income, and small caps, which is represented by the size factor right here, are the most attractive. So again, it's just not about how much risk you take. It's really, you must also take into account where you take on this risk. And valuations in the value and small cap space seem to be pointing to a potential opportunity. Another area of opportunity we see is overseas. It's really reflecting better valuation support than the broad, large US equity market, as both EM, which is right here on the left, and international stocks, again, are trading relatively cheaper to the S&P 500. So again, using traditional fundamental valuations, price to book for the EM, because that's the data set we have, and price to earnings on developed markets, so they have better reporting data. You can see, looking at the chart, that they're trading at almost record lows. Again, compared to its historical averages, this is not an absolute valuation measure. It's just trading compared to its history. It is trading a lot cheaper relative to the US equity market than it has in the past. And you see that fluctuates. So this is one reason we really like diversifying some of your equity exposure to the overseas market, which is better valuation support. So with that, let's turn to the fixed income land. We'll start with the yield curve. So we saw the yield curve steepen in the quarter, and you can see that right here by the blue line. This is the low end rate, this is the high end rate. And really, when you look at the yield curve, all you're looking at is the yield on US treasuries among different tenors, right? So this is what a 1 month treasury would pay, 3 month, 2 year, 5 year, 10 year, 30 year. We consider this the short end of the curve, and this would be the long end of the curve. And you can see where we came back from 2019, that all rates have fallen down in reaction to COVID. But when we look at the quarter, and the beginning of the quarter is represented by this aqua green line here, you can see the long end did rise in the quarter, which caused that steepen because the long rates rose. And it really was based on this increasing inflation expectations and brighter growth prospects. Not much movement in the short end as the Fed has direct control over the levels, but the steepening is really coming from that long end, which the Fed can influence but cannot control directly. A concern would be if we saw an acceleration of rate increases at the long end, but not seeing signs of that yet. This slow measured rise in rates is a healthy sign for markets as the economy continues to gain steam in 2021. So drilling down into the 10-year rate, represented by this blue line, you can see that's yielding a paltry 0.93% of the current market, almost at the record lows throughout history. You can just see how low we are compared to history. And once you take into account inflation levels, which is up here, is at 1.65, you come up with the real yield. And what the real yield is, all it takes is that nominal treasury yield, 0.93, and takes out the inflation rate, 1.65. So you get a negative yielding treasury once you take into account the inflation, or the cost of money. So this is negative. So this is good for borrowers, right? Because you can borrow much cheaper, but not so much for lenders or investors looking for income. So again, there's always a trade-off when you look at these things. This really has been the main driver of the TINA trade, which you may have heard of. There is no alternative, so you can't go into the treasury market. There's not enough return there, and which really causes investors to seek out other asset classes like equities and corporate credit to invest in. So given this long-term backdrop, we really don't see a lot of opportunity to make money in the treasury markets moving forward. That changes when you expand your view to a more diverse set of fixed income assets, as they may provide some opportunity in 2021. So we're looking at that expanded fixed income asset classes. You can look at the aggregate we talked about, which is just an amalgamation of all the bond markets, including treasuries, but the mortgage-backed market, asset-backed market, think cars, think credit cards, commercial mortgage-backed market, corporate bonds, preferred, floating rates, emerging markets, and high yield. And what we're looking at here is the spread. And all the spread is just how much income you're receiving over treasuries. So when we look at high yield, the easiest way to explain it is we know that the 10-year note yields about 0.93%. Now, by going out to high yield, which again is riskier because you're lending to companies and they're not the best companies since from the high yield market, you can gain an almost 4% extra in income just by going out there. So it's in short term, spread is simply the amount of yield to be gained over the treasuries by investing in other areas of fixed income. You can see quickly from the chart that we're almost at record lows here too. I keep saying record, but again, 2020, 2021 has been amazing for records. I think it's probably the record for the most breaking of records in the financial markets. And we'll see they're at record lows here. And these tight spreads is usually a sign of a healthy outlook by investors on potential future economic growth, as spreads tend to widen when investors get nervous about the future. And it makes sense, right? Because if you move out into the riskier parts of the market, you get more income for doing that. If you have a negative outlook, if you really see some trouble ahead, you're going to request more income from some of these borrowers, and you're not seeing that yet. So again, no trouble from the spread market here. Another way to look at the opportunity and risk in fixed income land, and yes, there is no reward without risk, is a measure called duration. In simple terms, duration is a measure of how much an investor stands to lose if yields rise. So what we're looking at here is a projected 1% rise in interest rates. Again, not in our base case, but we do see higher rates going forward. And all it says that if all else being equal, rates go up 1%, what is your potential loss in a particular fixed income? And you can see where the duration really lies here. It really is in these treasuries, since there's no performance if rates rise. By moving out into the different parts of the fixed income market, you get a very different picture in certain instances. So the higher the duration, the more dollars at risk to rising rates. You know, that 1%, like I said, is not in our base case, but we do expect rates to be upward sloping, and you can see that protection you get by diversifying your fixed income holdings. Again, just pointing out high yield for an example, that if rates rise by 1%, all else being equal, you have a little bit of protection. Not a lot of income to be earned, but you do have some protection there. And this low rate environment we're seeing really is not just a US phenomenon. It truly is global, as can be seen by taking a look at what government debt yields across the globe. And you look at the top chart up here, you can say that's our Asian friends, so it's Japan, India, and China. Look down here, we're focusing more on the European, Germany, Italy, United Kingdom. You know, actually, you look at Germany, it's actually negative. So what that says is that in order for me the privilege to lend Germany money, I have to pay them over and above the money I'm lending them, which is just absolutely amazing to me. And Germany's not the only one, but it's just amazing. So again, as we saw in the equity market, where you take risk in 2021, not just the level of risk, will be crucial in successfully navigating financial markets. So that basically sums up where we are in the equity markets and the fixed income markets. And our next lens we're going to look at is the economy. And we're going to begin by looking at the real-time data. I find this very interesting, but also very scary. So what we're looking at here are metrics that give us some insight into what is happening in the economy right now on the ground using newly available data sets from metadata compiled by cell phone and internet apps. In other words, yes, Big Brother is watching you. Now they say the data is anonymous, they can't get in your name, but again, in general, Big Brother is watching you whatever you do when you have your cell phone and your computer on. The data really begins when the lockdowns first appeared. We looked here in February. You can see how the economy came to a virtual standstill in the spring, just a massive fall off in economic activity going on right here. And then we saw this in the spring, the slowly reopened as 2020 moved along. A quick glance shows just how far we have come, but it also shows how far we have to go, but it is headed in the right direction. We did see a slight pause at the end of 2020, and you can see that in the data here at the end. And it was really most likely due to concerns about the stimulus, the election, but when we take a bigger step back and look at the overall picture, the trend is still positive. So people are beginning to get back to some sense of normalcy, which is good for the economy. Turning to monetary conditions, you can clearly see how accommodating the Fed has been with a tremendous rise in its balance sheet at the beginning of 2020, almost a doubling, which you can see right here in the lower left-hand chart. So again, this is just the amount of debt the Fed is buying in the marketplace and putting it onto their balance sheet. So when they buy the debt, obviously they translate that into cash. So we have an offset to this rising Fed balance sheet is the amount of money sloshing around the economy, which can be seen on the chart on the right, lower right. And we use the M2 as a proxy for how much cash is actually in the system. And you can see it's at record levels and shows no sign of slowing. You know, when we look at these two things combined with putting aside whether it makes sense to be doing the stimulus or not, the Fed shows no signs of stopping. The balance sheet's going up to the right, the money's sloshing around, and this has been and will continue to be highly supportive of asset prices, as the Fed really showing no signs of turning off this spigot anytime soon. They're in the market right now, basically have pledged to purchase $120 billion of bonds, 80 billion in treasuries and 40 billion in mortgage backs a month. That's not the overall for the year, that's a month. So highly supportive of risk assets. There is an offset to this too. So turning to the fiscal picture, we got to pay for this somehow. And we're looking at the US government balance sheet, and they really show no signs of removing support as for the economy as well. And you can see that in the two charts on the right-hand side. In the lower right, you can see the amount of debt the government has been taking on. And again, this line is actual debt, and anything after the line is a CBO forecast. And CBO is a government organization, has no stake in it. It's not an investment company, and they just do an independent projection of what they see. And they see, like we all do, we don't see the amount of debt the government has slowing down anytime soon. The chart to the right, you can see why. This is the budget surplus deficit. Again, anything above this means we're in a deficit. Anything below, we're in a surplus. We had a little bit of surplus in 00, but again, looking out, deficits as far as the eye can see. And you can see why. So you look on the chart on the left, this is the 2021 expected spending limits for the government. So again, when you look at total spending, you can see it's broken out by Medicare, which is the biggest piece here, Social Security, defense, and so on. You come up to 5 trillion. You look at how they can finance that. Well, there's income, Social Security taxes, corporate taxes, and a little category of other. And the biggest, you can see right here, is borrowing. So again, even without any new stimulus or spending, the government has no choice but to keep borrowing at least 1.9 trillion, and that's trillion with a T, before any new stimulus is focused on the economy. So again, no signs of this slowing down anytime soon. So where does all the support go, right? They're trying to help the consumer, and it really is translating into a much healthier consumer. And what we're looking at here now is consumer balance sheet and the consumer's financial position. And you look at the consumer debt service. So again, this is debt payments as % of disposable personal income. So think about like cash flow. All those being equal, you can see that the amount of debt and interest we're paying is a lot less than what we're bringing in, and it's almost at record levels. And we also see from the chart below that, net worth of the average household. Everybody has different situations, but when you add up all the data from all parts of the country, you can see that household net worth is at the highest it's ever been in throughout history. So we move over to the balance sheet, and compare that to the government's balance sheet we saw on the previous slide. You can show the large disconnect between the two, right? It's almost absolutely reversed. So look at the assets consumers have and the liabilities they have. You can see this big mismatch, and this is kind of what the Fed and the government stimulus is all intended to do, is to make the consumer in a much better position, and it's been successful. Look at the consumer at the overall level from all these data points. They're in a very strong position and has the capacity to grow spending. As we all know, it makes up over 70% of GDP. So this should keep economic activity humming along in 2021. So again, the consumer is very highly supportive of the economy. Turning to employment, we're seeing a much brighter picture. Disregard what the Fed said 2 days ago in terms of weakening employment picture. We don't really see that in the numbers yet. The data is really pointing to an improvement in employment picture. You can see from this red line this is the unemployment rate, so it's coming down, headed in the right direction. Still very elevated towards history, but headed in the right direction. So we're seeing improvements in the equity market, and we're seeing people come back into the labor force, which is a good thing, being added to the labor force. And then we look at what all this means. As more people are working, well, they're earning more. And you can see that in the average hourly earning numbers down here, that they're increasing and up and to the right. So again, taking a big step back, looking at the data, you see unemployment getting better. So unemployment rates coming down, more people entering the workforce, and they're earning more. So again, all positive influences on the economy and the investment environment. Another way to look at the economy is housing. And given the low rates and all the cash sloshing around the system, it's no surprise to see continued strength in the housing market, since mortgage rates are tied off that treasury rate. It's not directly related to that, but the lower that rate is, the lower the mortgage rates can go. But in addition to that stimulus, you're really seeing good long-term secular growth in the housing market, because we do see a continued rise in household formations after a long period of stagnation. And you can see that right here in home prices, upwards and to the right, again, heading to the northeast, it's good. Housing starts, green, again, new houses are being built. Again, a little bit of rollover in the data here, but again, it's not seasonally adjusted. It's January, but again, you can still see it's going in the right direction, upwards and to the right. So again, even if rates to rise, which again, we think they will, the secular tailwinds from this demographic shift we talked about, with more people forming households and buying houses, it provides support for this robust housing market. And housing market is a great driver of economic activity, because if you think about what happens when you buy a house, you buy new furniture, maybe get the floors fixed, maybe a paint job, Mortgage people make money. You hire workers to fix up the yard. Again, just generate some economic activity, which is all good. So turning to inflation, which we talk about a lot. Inflation is rising. No other way around it. We saw some numbers today come in pointing to that too. But again, it is off low levels and still way below the Fed's 2% average long-term target. So you can look right here, inflation coming in, a little bit weaker than 2%, 1.2. It can run hotter for a while, as the Fed has stated in its numerous communications to the market that it's going to look at an average rate and not raise rates just when it gets to 2%. So it's headed upwards, and we can see that in the next chart because the bond market really sees inflation rising over the next 5 years. As this rate of change indicates inflation may surprise to the upside. So the previous chart was looking at what inflation was, where it came from. So what was inflation in November? What was inflation in September of 2020? What we're looking at here is another way to look at inflation is inflation expectation rate. And without going to a lot of detail, basically all this is saying where investors think inflation is going to be in 5 years, lower or higher. And this year we're using a 5-year period. And you can see that the assumptions of inflation have jumped up tremendously in the back end of 2020. It's up about 2%. So again, not stagflation, not these real high rates rates of inflation we saw in the 70s and 80s, but headed in the right direction and moving forward. So again, a little inflation is a very good thing. A lot of inflation, well, let's hope we don't have to find out. But at least for now, this little inflation we're seeing in the marketplace is pointing to a healthy environment if you look out in 2021. Now, broadening our view and looking at the global marketplace, we get a very similar picture from the economic data. The global economy is still in expansion mode, with the exception of European services, which is this blue line here. And that really has to do with the fresh COVID lockdowns due to the new strain they had. But again, it's still headed in the right direction. So what we're looking here is services on the left, all the service indices in Eurozone, US, and China, and the manufacturing. So what are people making? And you can see anything above 50 means we're in expansion. So you can see all across that we're seeing expansion in China, in the Eurozone, the United States, in manufacturing, and also in services. So again, continues to be a very positive influence on risk assets and is indicating good, strong future economic growth in the marketplace. In case you're in a cave over the past few months, we did have an election in the fourth quarter, and we did have a new administration was sworn in January. And while it's still early in the process and the details are likely to be very fluid, we can get a glimpse into the priorities of the new administration and where the political conversations are likely to be headed in 2021. So again, increased spending. You can see where President Biden's policies have been targeted in the past, or what he has said on his website. Again, he's targeting healthcare, going to target climate and infrastructure the most, education, higher ed. So you can see where he should be focusing his attention and will be as we move out in 2021. And even though this increased spending, which is usually good for the economy, is front and center in the news cycle, something is missed in this, right? This has to be paid for at some point. So there could be potential tax increases that could have influence on markets in 2021, and you see that in the bottom chart. So again, just taken right from President Biden's plan, what he has said he would like to do. Again, no guarantee he can get this in. He has to work through Congress, work through the people to make sure, but you can see that he is targeting a little bit higher tax rates. So corporate tax rate, income payroll tax, small biz tax, cap gains. Again, you can see where he's targeting the biggest jumps. This cap gains and div would have very big impact on investment markets, which I don't think is being priced in yet, and small biz tax. So again, I don't think this is something it's a near-term concern, because again, a new president starting off the administration, do you really want to start talking about taxes and everything like that? But it's definitely something to watch out for in the latter half of the year to see, and we'll have to see how that plays out. So before we turn to our risk model, I would be remiss if we didn't at least touch on the state of COVID virus. And I am really looking forward to the day when I really don't have to show this chart at all. But at least, and for the good news is it's headed in the right direction. And what we're looking at is the 7-day average of cases per million of people across the different geography regions in the US, Northeast, South, West, Midwest, and it's all headed in the right direction. As this vaccine rolls out, we're starting to see glimmers of hope and cases are headed in the right direction. So again, still at elevated levels, still seeing cases, still something to be concerned about, but at least we're starting to see some progress, some light at the end of the tunnel, which is good to see. So with the vaccine rollout, the strong technical picture, strong economy, different valuation picture, we have to look at our risk model. What is our risk model telling us about the current investment environment, putting all that data together? Now, we don't use those particular data points. We may use some of them. We have our own internal data points we use. But again, we bring this up at the aggregate level so you can get a picture of the overall health of the investment environment. And it came in at a very robust +8 this quarter. Increased by 4 in the quarter, as 3 out of our 4 lenses showed improvement. And we talk about lenses, we talk about technical, valuation, and economic. You can see the total score right here is a +8. So pointing to a very positive risk environment. Drilling down to the technical picture, which is up here, structure and reversion. So again, +4, +2. The overall score was up by 1 to an overall +6, pointing to a very positive technical picture. All the sub indicators are neutral or above in this. So we have 6 positive technical indicators, and the 2 that aren't are still only neutral. So nothing really negative on the technical side. Very strong position. The structure of the market is very healthy. We continue to see the right parts of the market outperform, and we see increased breadth in equity market performance. That's all good for markets. Reversion, still positive. Really not seeing any signs of reversal in any of the trend indicators that we monitor. So again, overall, from a technical perspective, a very healthy, robust market. Valuation is the lone negative at -2. It did improve by 2. As we saw a positive change to the trajectory of earnings, which we showed earlier that earnings are really starting to improve. So that caused that number to improve by 2 during the quarter. But still, looking at the valuation picture, it's still, as we saw in those using the S&P 500 for the proxy, really still painting an overall negative picture. And it is negative and continues to be a concern as we head into 2021. Looking at the economic picture, it increased by 1 to a score of +4 and is at its maximum positive level. So again, really strong, robust economic numbers, and is really causing a very positive influence on the risk environment from the economic data. Qualitative, that comes in at neutral. So again, when we look at qualitative data, it's using the years of experience we have at Stonehearth between myself, Jamie Upson, the owner of the company, and our 2 other advisors, David Giuliano and Andrew Nadeau. And we've been in the markets for many years, and it's just our judgment. And again, when we look at this, we really are balancing 2 distinct different risk rewards to come out to net neutral. It's that all this liquidity that the Fed still has your back. That's a major positive to the market, but it comes at a cost of a huge, tremendous amount of debt. So again, when you try to balance those 2 out, it really doesn't swing negative or positive either way, which is why we come out with a qualitative ranking of neutral in the quarter. Again, so really no influence on the overall model score. So taking a look, what does the big picture tell us? Well, the weight of the evidence points to a very healthy investment environment for risk assets, as a positive data we are seeing in the economic front and from the technical indicators really do outweigh the neutral qualitative reading and the negative valuation picture. So the weight of the evidence is definitely screaming positive for risk environments. So how do we translate all this information into a portfolio, right? And we look at that through our portfolio positioning. We're going to different the asset classes here. We look at equities and we break it out between the US, international developed, again, think Europe, emerging markets, think, lower Asia, South America, fixed income, which is the aggregate, and so includes credit and duration, cash, and opportunistic. And you can see from the chart here, we're overweight equities in general. Again, we saw that robust Fed providing liquidity. We saw, tightening spreads in the fixed income market. So anything's pointing positive, we're positive in equities. We did have some valuation concerns, so we're underweight US. You can see that right here. Overweight international developed, neutral international developed, and overweight EM, which really has the best valuation support. When we look to fixed income, we're definitely neutral. Again, not taking big bets either way, going massively underweight or overweight, but within the fixed income land, we still like credit over duration, and we saw that reason why the rate's so low. Cash, neutral. Again, don't need to hold excess cash right now. An opportunistic bucket, we're still at market weight. We do have an overweight to precious metals and some of the frontier markets, but we continue to wait for a better setup to go overweight our opportunistic bucket. So that's where portfolios stand in terms of Stonehearth as we begin 2021. And before I turn to questions, I'm gonna go through some final thoughts here. So we look, positive technical market. The trend is your friend. Things are looking good on that front. We know valuations are elevated across financial assets, and it does pose a risk as we look out to 2021. Earnings continue to rebound from the lows, which really helps support risk assets. Seeing continued improvement on the economic front, off very low base, but still it's improvement. So pointing towards continued growth. That world is awash in cash and shows no signs of stopping anyway, anytime soon. So again, one of the rules we have is don't fight the Fed. Comes at a cost. Record levels of debt. Does not seem to be a problem yet with rates so low, but again, one of those surprises that could hurt us in the back half of 2021. Starting to see signs of accelerating inflation. The data and all that stimulus has worked through the economy. Again, like we mentioned, the world is awash in cash. COVID, it's out there, it's still there, and we saw the numbers getting better, but we're still not over the hump yet. It's very unpredictable. There's no really way to measure COVID, the impact it has, to predict what's going to happen with it, but you need to be prepared for whatever happens. And lastly, like I've said throughout this presentation, really where you take risk is going to be just as important as the level of risk you take in 2021. So I want to thank you for joining me today. Now I'd like to turn it back to Amanda to see if anybody has any questions.
Hi, Chris. Can you hear me okay?
I can, Amanda.
Okay, great. Yeah, so just as a reminder, right there in your GoToMeeting taskbar, there is a section titled questions. You can go ahead and submit them, but we do have a couple, so we'll just get started here. Chris, the first one is, given the high levels of debt and extreme valuations, how can you be so positive on the equity market?
Yeah, debt is a very major concern, and we've kind of shown that throughout the presentation, but it really isn't only one factor we look at. When we look at the total picture through that multiple lens approach, looking at technicals, economics, we're really seeing a more positive outlook. Technicals are strong, the right parts of the market are outperforming, economic data is coming in better than expected and points towards future growth. So, when we use the weight of the evidence approach, it tilts that scale positive even with that negative debt position. And we're also positive on particular parts of the market that have like better valuation support. We saw the small caps have a little bit better valuation support overseas. But all in all, yes, debt and valuations are certainly elevated, and it's something we're watching very closely. And investors really need to stay nimble and not married to a thesis, as conditions may change. But for now, at least, the overall lens tilts positive.
The next one I have here, Chris, is, where would you be looking for safe income in this market given the low rate environment?
Well, I don't think there is safe income in the market, but again, if you look around, we saw how low rates are, we saw what the Fed's influence on the interest rate market is. Given the low level of yields, I don't think there is any safe income. Investors are very limited in their choices. Looking for income, not safe income, because I don't think there's any safe income, but if you needed to find income, I would look to that more diverse set of fixed income exposures, like the credit markets, like high yield. You pick up a little bit extra yield there. Also, don't forget about the equity market. There's really many equities carry a higher yield than many parts of the fixed income market. Although it does come with more volatility and risk. In fact, when we take a broad basket of value stocks, they're yielding almost 2.5%. So there are ways to increase portfolio yield, but it does come with risk. And really, to me, there is no safe income.
Thanks, Chris. It looks like we've got just a couple more here. The next one I have is, with the Fed and government proving seemingly unlimited stimulus, why wouldn't you just buy U.S. stocks?
Yeah, it's a good question. Again, but at some point, it has to come to an end, right? There is a limit to the amount of stimulus that can be provided, and there's a cost to it. I mean, so you see the debt rising. And when we look around, the U.S. is not the only country providing liquidity. Stimulus is truly a global phenomenon. And when you look at the equity markets and you have a better valuation support, the more downside protection potentially from the valuation picture, I think investors would be remiss by not taking advantage of the benefits of diversifying some capital into other areas of the equity market, because we know that helps long-term risk return profiles of portfolios by diversifying some exposures. So again, I get it, but given the better valuation pictures, I do think diversifying into other markets helps investors meet their financial goals.
Chris, I don't think we can be surprised with this question, but what is going on with GameStop, and should I be buying the stock?
I was waiting for that question. Definitely entertaining. And let me first by stating, on these calls, we can't make recommendations on individual names and securities. So if you want to talk about GameStop as a potential purchase or sell or anything else, please give the office a call, and we're happy to talk to you on a one-on-one basis and set up some time to talk. But in general, again, for those who don't know what the GameStop question is, GameStop is a brick and mortar retailer that's been in the headlines recently, not for good reasons. Most likely, and like most legacy retailers, they were struggling with the fallout from COVID. So what happened was some hedge funds, right? Hedge funds are just an investment wrapper where people could do investments just like a mutual fund or an ETF, a little less regulated. But what they do is they saw this precarious financial position and built short positions in the stock of GameStop. So what is a short position? It's just I sell the stock now, again, which is just a transaction. I don't physically have to sell the stock. I enter into an agreement to sell the stock today. And what my goal in that is that hopefully the price falls and at a later date, I can buy it back at a lower price and took a profit. Some investors on a Reddit board, which I will remain nameless because I think it's actually closed now, but they took notice of this large short position and began to buy the stock to force a short squeeze. And what a short squeeze is by hopefully putting buying pressure on the stock, which raises the price. People who have sold it short previously need to buy that stock back to cover their short position. So again, by putting buying pressure on the stock, you hopefully raise the stock price, which then causes those hedge funds to buy back the shares they sold short at a higher price, which leads to more higher prices. So again, you can see where the self-fulfilling feedback loop comes in. Now, this is nothing new, and it's a well-known viable trading strategy. I think what is new was, who was doing it, right? It wasn't institutions, it wasn't hedge funds, it wasn't the investment companies of the world. It was individual investors joining together to do this, which I think is amazing to me. Also, I think the amplification effects of social media provided more fuel to the fire. So again, once it happened, people started talking about it, information was disseminated far and wide and a lot quicker. So 10, 15 years ago, you had someone on a trading desk doing this and maybe talking to a group of 30 or 40 people about this trade. Now you have someone doing this, talking to millions and millions of people on any given moment and any given second, telling them what's going on. And also the magnitude, right? So just the absolute ridiculous price discrepancy. So you saw the stock trading in like the $4 range a couple of years ago or last year, and now it's in the hundreds. And every tweet, every move by a regulator, it goes up and down $100 based on no underlying fundamentals. So again, it's just speculating, but it's always been in the market, always has been. Again, I think to me, when I look at it, the biggest story is what's going to come out of this. And I think the biggest things that come out of this is regulation, right? You have Washington looking at it now. They're going to have hearings on this, and it really driven by, and I hate to say this, it's driven by money, right? Why is everybody upset about this? It's because hedge funds got hurt. Hedge funds provide revenue to the exchange markets, to TD Ameritrade, and to the Robinhoods of the world. So the people who pay and fund their company are getting hurt. When that happens, they take notice and they do things, and that's why the regulation is going to start coming in. So again, other than that, the other thing to me, it's a good lesson in risk management, right? Because when I had a hedge fund for a while, I have shorted stocks before, and we always used to look before we short a stock. Do look at the short. How much is short out there? This information is out there, So to me, it really was faulty risk management by these hedge funds. They got in way over their ski tips, and they're paying the price for it now. That's what happens in markets. It's price discovery. So again, it's very entertaining and good for you if you were in the stock earlier than this. It's been an amazing run. I find it entertaining and we'll be following it closely, but I think the fallout that we're going to see from this and the major implications is going to be on the regulation front. And how we're going to predict that, I don't know, but I do think we're going to see some more regulations coming out of this as the hearings in Washington unfold. So that's my spiel on GameStop. We could be talking about GameStop for the next hour or two about everything that's going on with that. So if you want to talk more about it, please give the office a call.
Chris, did I read correctly too? I think the gentleman who actually started all this with GameStop is from Wilmington, Massachusetts. It's my hometown, but I guess he didn't feel the need to share that with his neighbors that he was going to be doing, because I definitely didn't get in on that. But don't quote me on that. I want to say
I'm not quoting you at all on that one.
But all right, it looks like we just have one more question for now. It says, what are the best opportunities in the market right now?
Right now, right this second. Interesting. So opportunities. This is always an interesting question to me, and I know people on CNBC get this all the time. Give me a best buy idea right now. Where you put your money to work and all that stuff. And they usually give you a nice, simple 10, 15, maybe 10-minute answer on that. which makes for great TV, but not really great for investment advice. Since when you really look at where you should be investing, you really have to take into account your own personal situation, the amount of risk you're willing to take, your capacity to take risk, your balance sheet. Are you a 20-year-old with no children just starting out your career? Are you a 70-year-old with retirement in the near future or already happened, just trying to survive on a fixed income? So again, that question is very hard to answer because it really needs to judge an individual's personal circumstances. But from the presentation, you can see where we're seeing some more attractive opportunities in the marketplace. You can see that, we do like the smaller cap stocks. Again, better valuation support. We like diversifying some of your exposure overseas. Again, we're seeing much better valuation support and some mean reversion to close that gap. We like value stocks, again, we think price matters, and you see that gap between value and growth closing in the fourth quarter, and we see that continuing. So you can find some opportunities there. And what we talked about in fixed income land, treasuries just don't look that attractive and more heading towards the credit parts in the market in terms of like high yields and floating rates. So again, it really depends on the individual situation, but that kind of gives you an idea of where we're finding some attractive opportunities in the marketplace right now. But again, if anybody's really looking for that type of advice, I would definitely call the office, talk to your advisors, talk to me, so we get into a total financial plan and your total financial picture.
Chris, I think that's it for the questions. I do want to remind everyone on the call that we do host these quarterly, so you can look for an announcement as we get closer to April. Also, this is always posted on our website as well as the recording from this webinar if you want to kind of look back and go through again kind of a study to give us a lot of information today. So Chris, thank you so much for joining us. Thank you to everyone who was on the call. We hope you all have a wonderful weekend, and we will catch up with you all soon. Thanks.
Thank you, everyone, and here's to a better 2021.
Yes, definitely. Thanks, Chris.